Every time. It's better to know than not knowing, because
I'm gonna get started.
okay, okay, I'll follow you. Oh, yes. So my presentation is showing here. Okay. Okay. Oh, our light is bright.
Yes. Hello, hello. You made it. Last session almost, yes? Okay, so welcome back. I am pretty excited for Amin, Janku, Kuanju to be here, and this session is sponsored by IA Financial Group. And so Amin and Janku is going to be talking about the transfer of life insurance policy rules and effects for corporations. As we know, when we set out as financial planners and we put together, life insurance policies in corporations, things ultimately change for their corporations. So how should we, what should we be aware of down the road when these plans have been put in place? Yeah, those are the things you'll be sharing with us more about. And so again, I asked about, what is your favorite Halloween costume? And I really like this one. So you dressed as Winter Soldier, Bucky Barnes from Captain America movies. Is that right?
Yes.
Okay.
Because he's buff.
Because he's buff. I love it. So I had to research, what does that say about you when you dress up as Winter Soldier? It says that you are charming, laid back, generous, and loyal. Although Bucky has had a charmed life, he's not at all spoiled. He's devoted to both his friends and his country and eager to help them in any way he can. Wait, there's more. Bucky can be a bit aloof as he's used to being popular and well-liked, but he never looks down on those who aren't as well off as he is. What do you think?
I don't know how popular I was. But
so again, please welcome. Let's give a round of applause to Min Jung-koo and as he leads off in our last presentation for the day.
Thank you. Thank you for being here. You guys hear me? Perfect. That light is it's very bright. I'm not used to hearing myself here. So thank you for standing for the entire day and then having to hear me as the last. We're going to be talking about taxing. We're going to be talking about transferring corporate owned assets. So I hope you enjoyed the subject. So I'm just going to go straight into my subject because I apparently have a timer, which I don't see here, because I could speak for hours. So just a little bit about myself. Thank you, Alicia, for the presentation. I'm a tax lawyer out of Quebec. So I've been practicing over close to 15 years. And I joined Industrial Alliance as a support, adding more support to the team. We have a large case team that we provide support to our advisors. Just a little bit about myself, you could read. I started my career working for CRA, Canada Revenue Agency. And after that, I actually spent almost 20% of my career in CRA. And then over the last 11 years, 12 years, I'll be working in the private sector. Just before joining IA, I was working in a legal firm. I had my own firm. I work also for accounting firm. So I was doing a lot of planning. So I was probably professionals here. I've done a lot of planning in my life. And then last year, an opportunity came and then I joined IA. So right now, as I mentioned, I'm going to repeat myself. I just help you guys when you have more complex, structure, and then I help you go through that. As I mentioned, I'm a lawyer, so I have to put the disclaimer here. So this is not advice. This is not a legal or tax advice or an accounting advice. This is just for training purposes, and it has to be used for training purposes. If you want to have more specific opinion and advice, I would totally recommend to go to professionals that could help you in your local market. I'm a Quebec tax lawyer. I can answer some questions in terms of BC, but it's very limited. It has to be limited to taxes. So today we'll explain the details regarding the rules surrounding the transfer of ownership of life insurance policy with corporation, and also to understand the effects. And more specifically, I'll present the different structure, holding structure that we mostly see, the consequences in terms of taxation, and also a little bit of legal consequences. And then I'll have a couple of examples with a few numbers to show what happened when we transfer policies. So this is our agenda, very straightforward. But before I go into the thick of the material here, I just want to set the table. I had to put this together because I just want to let you know, just present all the different tax rates in BC specifically. You probably know this, it's probably just a refresher for you. So these are the different rates. They're going to be useful for the entire presentation. So keep in mind, for a corporation, this is in BC, we have two rates, 11% for the small business deduction. SBD stands for small business deduction. And then we also have the general rate. So the small business deduction is the first taxable income on active business income. It's 11%. After that, the general rate is 27%. On investment income, the taxable capital gain, 25.35, which is basically half of the interest rate of 50.70, royalties and rent also 50.70. And then finally, dividends for public corporation is 38.33. And right there, you see Part 4 taxes, because it might be Part 4 taxes in some cases also. And then finally, foreign corporation, 50.7. So now let's talk about the personal. On the personal level, we all know we all tax at the graduated rate. And then these are marginal rates, 53.50. On dividends, 48.89. And on non-eligible dividend, and then 36.54 on eligible dividend. And finally, again, capital gain, 26.70. Right there. So now I'm going to go right into the thick of the matter. I'll talk about the passive income rules. Remember previously I mentioned the SBD, small business deduction at 11%. That's on the first $500,000 taxable income. In 2017 or 2016, can't remember exactly, these rules came into place, the passive income rules. These rules are made to grind down that $500,000 of taxable income. So the way they work, first, they work on passive income. What are passive income? They're dividend received from a non-connected corporation, their capital gain, and then their interest rate and net rental income. So when an active corporation generates one of these revenue, that active corporation might be subject to these passive income rules. So the way they work is that on the first $50,000 of passive income, there is no grind down. Anything over that $50,000 passive income, there's a gradual grind down of the business limit of $500,000 all the way down when we reach the amount of 150. So in terms of number, let's look at it in terms of number. The way it works is for every dollar over that $50,000 threshold, there's a $5 grind down. So let's take an example. Right now, the prime rate in Canada it's around 7%. So let's say you have an active corporation that has a retained earning of $1 million and then additional cash. If that corporation takes $1 million and then invest into a very safe investment at 7% interest, that corporation is going to generate $70,000 passive income. So on the second line, you'll see that $70,000 passive income that's going to grind down the business limit of $100,000. So the business limit is down to $400,000 and all the way down to to 150 where there is no more business limit. By the way, before I go and actually show you the numbers, I just want to make sure you guys understand this. The $500,000, it's based on the entire associated group of corporation. What are associated corporation? Associated corporation, there's different ways corporation can be associated. These are just three ways. These are three legal ways that a corporation can be associated. In the law, there are about 10 pages in the law to trap or to associate corporation together. On the one on the left, corporation one controls corporation two. Second example, shareholder control both corporation one and two. The two corporations are associated. And then on the third example, corporation one is associated with corporation two, just because that parent they're related to son. And then corporation one and two are associated with corporation three, because they both control corporation three. So in this case, in the last scenario, all three corporations will be associated, and all three corporations would have to share the $500,000 if they're all active. These are more examples, even more specific, where in this case, we have Mr. A that controls corporation one and also owns 25%. In corporation two, in this case, corporation one and two are associated. And then again, corporation one and two in the last example is also associated. These are just 5 examples. In the laws, is 5 more where we have economical association. That could be a de facto association. We have a legal association also that's possible. So now knowing that the $500,000 would be shared between the associated corporation, let's look at what an additional $20,000 relates to when in terms of taxes. So let's say in my example, we have $1 million, 7% of interest, $70,000 of income. That $70,000 of income equals $20,000 surplus income over the $50,000 threshold. So that's a reduction of $100,000 of business limit. Because of a loss of that small business rate from 11 to 12, that's a 16% loss. So on that additional $20,000, there's 2 things that's going to happen. First, it's going to be tax paid on the passive income. So half of it, $10,000 will be taxed on the passive income. And second, on the active income, there's an additional $16,000 paid on that $20,000. So altogether, the corporation generates $20,000, and the corporation has to pay $26,000 taxes. Is that a good investment? Not really. So if I push the exercise all the way down to the $150,000 limit revenue, now the corporation generated $150,000 income. There's 50 of it is tax at $75,000 tax, and then there's additional tax on the active income. So that 150 of additional passive income generated in this example $155,000 taxes. So all this to say, if you have corporation that have additional income, that have retained earnings, if they use that retained earning to invest within the corporation, they might be subject to this passive income rule. So you have to be careful where we invest. So this is where life insurance comes into play. If you remember, I said earlier that this passive income apply to dividend, rental income, royalties, but not life insurance. So now that $1 million of retained earnings, that could be used toward subscribing into a policy, a life insurance policy. So These are just a couple of applications. How do we could apply a life insurance to pay tax at death, to cover a key person, a shareholder is a key person, to cover shareholder agreement, you have two partners, and then in case of a death among the partners, you want to be able to buy back the shares from the estate of the deceased, to finance repurchasing shares. You could also use to shelter taxes, because all the investment, all the growth within a life insurance is not taxed. It could be used to create wealth. It could be used for corporate loans. So we have different strategies that we do to leverage the cash value of a life insurance within a corporation. So these are some of the benefits. Sorry, these are some of the benefits. I just want to just spend a few minutes on the last four. So having a corporation owns a policy allows to create a capital dividend account. Premium are paid at a lower price after tax dollar. Not lower price, but after tax dollar. We have strategy that we can implement by using the lower after tax dollar, and then they're not subject to passive income rules, except that they might be subject to what we call lifetime capital exemption. So this is just a quick example. I just did the calculation for you to actually see how the premium is actually cheaper in a corporation. So if you were to own a $12,000 premium, $1,000 times 12 months, the individual would have to have a salary of $25,807. If it's a business, for the same $12,000, there's only a need for $13,484 in case there is a small business deduction. If there is none, it's $16,439. And these are all based on the DC rates. So it's not all perfect. There is also disadvantages of having a corporation-owned life insurance policy. They're not protected for creditor. So that's a question I always ask our clients. What's the risk? What's your legal risk? Are you exposed to creditor? That could be an issue. If it was personally, also could be an issue, but something to be aware of. As I mentioned just earlier, it could be a bad asset when it comes to time to look at the capital gain exemption, because life insurance it's an investment vehicle, so it's not used actively in the business. And if it's not used actively in the business, it becomes a bad asset for QSBC, stands for Qualified Small Business Corporation. It's usually to be able to take advantage of the capital gain exemption. 90% of the asset have to be used in the active business at the time of disposition. That could be an issue. That means an additional at 26.75%, that's additional taxes. And also, the premium are not deductible. Life premium are usually not deductible in a corporation, except if there is a collateral loan taken in the corporation, and that collateral loan is required by the bank. So those are the couple exceptions where we could deduct the premium. So now, knowing all this, that's the legal and the tax side. Knowing all this, now I just want to show you a couple structure that you would see in your practice. So the common one is you have operating opco that owns holding. Shareholder owns holding owns opco, and then the holding has the policy. The holding is the owner, payer, and beneficiary. There are a lot of benefits. I see 80% of the structure that I see, that this is the case. There is no taxable benefit for the premium paid, because it's just going to be dividend paid from opco. There is no impact on capital gain exemption. In this case, it might not be the perfect structure for capital gain exemption, but you have to keep that in mind. There is no impact for capital gain exemption. There is no transfer, no likely there would be any transfer in this case. And the creditor, it's not an issue for creditor because in this case, most likely, holding doesn't have any creditor because holding would have investment and then those holding wouldn't have any creditor. Point of awareness, the accounting, that's more of an accounting job. And safe income issue. Safe income issue could be an issue if in case, let's say there's a huge dividend paid from OpCo to holding right before OpCo is being sold to a third party. So you have to be aware of the safe income issue. Essentially, safe income issue is if OpCo were to pay a dividend to holding just to lower the value of OpCo, well, that dividend will be considered tax at a capital gain rate instead of being tax-free, because in this example, the purpose of the dividend was to lower the value of the OpCo, and then when the value of the OpCo is sold at a lower value, the capital gain will be lowered also. So this is where it could be an issue. But there's ways to, there's also exception to that safe income issue, and it's just up to the professional to know those exceptions. This is a second structure where the opposite. Now, in this case, OpCo owns the policy and pays, and then also the beneficiary. This is more, it's more rare. One of the reasons where you would have this, let's look at the benefit, and then the benefit is that the premium is paid with the business income money, so at lower rate. It's simple accounting. There's no taxable benefit. However, the surrender value represents an asset in the financial statement. What does that mean? So as the policy grows over time, there's cash value that's going to show up on the balance sheet. And then that could be an issue when it comes to time to sell, because as I mentioned before, the cash value and also the fair market value could be an issue because it's not an active asset. And because it's not an active asset, it could be an issue when it comes for lifetime capital gain exemption purposes. And also, there's a risk in terms of for the creditor. And I just mentioned that. And then most likely in this case, we'll have to transfer the policy to the holding. But the reason why you would have this structure, it's mostly because it's unlikely that the OpCo will be sold. It's unlikely that the OpCo will be sold. So the capital gain exemption is no longer an issue. And then it could be also used for leveraging. Having a policy in OpCo like this could be the cash value within the policy could be used as a leveraging tool for financing, financing equipment, financing an acquisition, any financing. This is another structure. In this case, the only difference is the owner pair is holding, and then beneficiary is OpCo. In this case, there is no taxable benefit on the premium. There is no impact on capital gain exemption. The transfer of ownership is unlikely because the ownership is already in holding. There's possibility of using dividend to pay the premium. And then the cash value is protected against the OpCo creditors. You just have to be aware in this case, the death benefit is not safe from the creditor. So when the shareholder passes away, the OpCo is the beneficiary. So that's the creditor they have access to that. And again, there's no benefit for the CDA because since 2017, there's no benefit on the CDA. And then again, safe income issue. This is another structure where now the holding is the owner, and then the payer and beneficiary is the operating OpCo. In this case, there is no taxable benefit because the payer is the payer beneficiary is the OPCO. However, also there is no transfer. The transfer of ownership is unlikely, and then the payment, the premium is paid with active income. However, in this case, there might be a taxable benefit under 15 shareholder taxable benefit under 15(1) of the Income Tax Act. ITA stands for Income Tax Act. If the surrender value is greater than 0, and also death benefit is not protected against creditors, and then there is no issue for the CDA here. So I showed you a couple structure. These are just there's more structure. I didn't show you a partnership. I didn't show you trust. There's a lot more structure, but I just wanted to focus on some of the structure that we could see when we have cooperation. All that to say, these are just a couple of key takeaways. Holding a policy through a corporation is often a good idea because the cost could justify it, meaning that you're paying a premium at the lower after-tax dollar. However, you have to keep in mind, you have to always consult professionals to make sure that the structure you put in place makes sense. If the beneficiary, well, one of the reasons is because if the beneficiary of the policy is not the owner of the policy, it might be a tax issue, one of which is taxable benefit. And also, there might be an issue with capital gain exemption. This says knowing, so sometimes you have a structure where this is already set. So what do we do now? Maybe we need to transfer the policy. Before I go into the details of a transfer, first, you have to know what's a transfer. What's a life insurance transfer of an ownership? According to the ITA, the transfer of ownership equals the disposition of an interest of in the life insurance. These are just a couple of examples of what's a transfer of ownership. Surrender. The policy is surrendered to the life insurance company. It might be a policy loan. If in certain circumstances, the policy loan could be an issue, and it could trigger a taxable event as a transfer of ownership. There's significant changes to the policy. That's a question of fact. Is a conversion to transfer of policy. It's a substitution. It's a substitution of an insured, a transfer of policy. Obviously, change of ownership is a transfer of policy. So these are some of the questions that we need to ask ourselves when it comes to changes to a policy. Are those changes going to trigger a change of ownership? Or even if it's not a change of ownership, are they going to trigger a dim disposition for tax purposes? And now I'm going to get into more specific provision. There are 3 types of transfer that can be considered. The transfer that follows the general rule under 148(1) of the, it's actually a typo here. You see LIR, that means for l'impôt sur, la loi de l'impôt sur le revenu. That's in French for Income Tax Act. So when a policy owner disposes of his policy interest in favor of a non-arm's length transfer, the transfer has to be at fair market value. In case it's not done if it's done in an arm's length transaction, it has to be done at the amount decided, negotiated between the 2 parties. The more specific rule, 148(7), not when the transfer is not done at not at arm's length. It's when the parties are not dealing at arm's length, the transfer has to be done at the highest of 3 amounts. CR stands for cash. PR stands for SCV. That's funny though. That's a bad translation here. It's the highest. I did this presentation in French, and I didn't notice this. So when you transfer under 148.7, it's the highest of three amounts. The cash value, that's what CV stands for, cash value. The CR is the consideration received by the transferor, and then ACB is the ACB. So usually the consideration between two related parties is usually zero. So it's usually the CV cash value and ACB, the cost. And there's also specific rules under 148.8, 8.1 and 8.2 of the ITA. Those are more rollover between spouse to a spouse, to a child, to a grandchild, and then to any person not dealing at arm's length. I'm not going to touch the last exception. I'm just going to focus on the 148.7 in this case. So let's just read for a second 148.1. Amount to include in computing the policyholder income. They shall be included in computing the income for a taxation year of a policyholder in respect of the disposition of an interest of a life insurance policy, the amount by which the proceeds of disposition of the policy became entitled exceed the ACB, adjusted cost base, to the policyholder before the disposition. Basically, it's the proceeds of disposition minus the ACB equal the amount to include into the income. And then the proceeds of disposition means the amount of proceeds that the policy is entitled to receive on the disposition of the interest of a policy. So when there's a transfer of policy, these are the tax consequences. The life insurance is not eligible for tax rollover. You heard about the 85 tax rollover. Life insurance is not eligible for tax-free rollover. So now knowing that, anytime we transfer policies, it's going to be, there will be a disposition, and that disposition may or may not trigger a taxable gain. And if it does trigger a taxable gain, we have to calculate the taxable gain. It's the consideration received minus the ACB, which is 100% taxable. They're not capital properties, so they're not taxed as capital gain. They're 100% taxable. And on top of it, for the beneficiary, the consideration is paid for is the ACB for the new policy. These are just an example where you have a minority shareholder that owns you have two partners. One owns 49%, the other one owns 51%. And it might be also if the fair market value is this is when you have an individual and a corporation. If the corporation is a transferor, so the corporation is transferred to the individual, 15.1 might apply if the consideration received is lesser than the fair market value. So what does that mean? So the transferor is the corporation. So the corporation is transferring an asset which is value higher than the price that the individual is paying for. This is why 15.1 can apply. It's the opposite. If the corporation is a transferee and the individual is a transferor, that means the corporation is paying more for if the consideration paid for by the corporation is higher than the fair market value, the shareholder might get a 15.1 taxable benefit because the shareholder is paying for something. No, the shareholder is actually receiving an asset at the lower price for the amount that they receive for. So there might be a taxable benefit in that case. So now let's go into the specific group of 148.7 when there is a transfer at the non-arm's length. So A transfer at non-arm's length is when the interest of a policy in the life insurance is disposed of by way of gift, distribution from a corporation, meaning dividend, or in any matter, whatever, to a person with whom the policyholder is not dealing at arm's length. If a shareholder owns a corporation, the shareholder of the corporation are not dealing at arm's length. They're related, but they're not dealing at arm's length. And then here are just example of what we call not dealing at arm's length in the law. So for individuals, when they're connected by blood, by marriage, by common law partnership, they are considered not dealing at arm's length. I am related to my wife and to my kids and to my mom, but I'm not related to my nephew or my niece. My nephew and my kids are not related. So it always go up and down, it doesn't go on the side. By the way, except I'm related to my sister, but I'm not related to my niece or my nephew. For corporation, a person who controls the corporation is related to the corporation. When two corporations are controlled by the same person, the two corporations are related, and obviously the two corporations are related to the person. And then when two corporations controlled by a related person, my wife has a company, a corporation, she owns it 100%. I have my own corporation, I own it 100%. Our two corporations are related because my wife and I are related. So, and also there's a question of fact. This question of fact is mostly when you have two unrelated parties. Me and my neighbor, we are related, but we act in concert when it comes to transfer. How are they going to show it? Or we have email, we have exchanges. We talked about exchanging a policy. We acted in concert. There is no, you're not acting at arm's length. You are acting together to transfer the policy. But that's more of a factual control and relationship, which is a question of evidence, a question of going to court and then proving your point to CRA. So, okay, this is a specific rule. This is just a repetition. It's the greatest of three amounts: cash value, fair market value of consideration received, and the ACB, regardless of the fair market value. What's the fair market value? I mentioned that several times. This is a definition of one of the interpretation bulletin by CRA. It's the highest price expressed in dollar that can be obtained in an open market, which is not subject to any restriction when the party to the transaction are well informed, they're acting with prudence, and there are no arm's length relationship between them, and neither is in any way into the concept in the transaction, in any way compel into the transaction. It's compel. That's very important here. So in the information circular, CRA came with how do we evaluate policy, life insurance policies? It must be done according to normal valuation practices, considering the facts, namely the life expectancy, the health of the insured, and other circumstances. On the next slide, I'll list a couple of circumstances to take to consider. And then the value of the policy may be greater than the surrender value. So these are the some of the element that actuaries look into when they make the evaluation of a policy. They look at, is it a term versus a permanent, the level of cost of insurance, the issue date, any health changes, what's the economical environment, what's the guarantee insurability, conversion option, and the riders also, guarantee all riders. So get in touch with your actuary to get more detail in how they what method they use and how they get to their evaluation. So when this is just a repetition, I'm not going to spend time here. Transfer specific rule. All right, so why do we transfer? So knowing this now, why do we transfer? We transfer because, let's say, the policy is owned personally, and that policy, the client wants to transfer into a corporation to be able to pay at the lower after tax dollar. We transfer, we could do that just before selling. Prior to selling, that could be a reason to transfer policy from a corporation to an individual when the corporation needs to be wind down, when there's a reorganization, when the situation has evolved, when the cash value becomes an issue for capital gain exemption, or just when we want to update the structure. Those are some of the reasons why we transferred. So now I'm going to go into more specific calculation. What happened when we transferred? In the first example, we transferred from the shareholder to the corporation. So again, because this is under the specific rule of 148.7, we have to look at there's a dim disposition, which is the highest of the surrender value, the ACB, and the consideration received. In this case, fair market value is not a big issue, and I'll show you why. But in other cases, knowing the fair market value could be detrimental, and not knowing could have a very costly tax consequences for the client. So in this example, we have a very small policy, ACB of $50,000, cash surrender value of 125, fair market value of 250. I have 4 assumptions here. There is no consideration. The individual is just gifting to the corporation. I don't know why, but that could be a reason. That could be something that could happen. In this case, this table shows you the different tax consequences to the shareholder and to the corporation. So if there is no consideration received, it's the highest of 3 amount. The dim disposition is the highest of 3 amount. The cash value, the ACB, and the consideration received. In this case, 125 is the cash value. That's why you see the 125 as the dim disposition minus the ACB. There is a gain of 75,000, 50% of taxes. And then on the corporation side, there is no amount paid. It's a gift. There's no taxable benefit. And the corporation receives the new ACB at 125. Very simple. As you go down, even when the transfer is done at the fair market value of 250, there's a gain of $200. I don't know why the taxpayer would do that. There's a 50% tax of 200 on the $200,000, and on the corporation side, there's nothing. Usually, I don't recommend that. I just recommend the client to have at least a promissory note. So at least if you take out the ACB or even the cash surrender value, no, mostly the cash surrender value of 125, be able to take out that money tax-free over time. So now let's look at the opposite. Let's say corporation needs to be sold. We transfer the policy to the individual before selling because we want to take advantage of capital gain exemption. Again, it's the same principle. Now let's have numbers. I changed my numbers. I put a couple more zeros here to show the real impact. This is more realistic here when you have a policy of a fair market value of a 1.5, cash value of $1 million, ACB of $100,000. Again, my 4 assumptions. So now let's look at the tax impact here. If the corporation pays a dividend in kind, there is no consideration paid by the shareholder. In this case, we're looking at the first line without consideration. For the corporation, it's going to be a gain, policy gain of $900,000, on which the corporation would pay 50% of it as a tax. On the shareholder side, you see that the column in the middle, it says taxable benefit. There's a taxable benefit of $1.5 million. The reason why is because the fair market value in my example was 1.5. So on that 1.5, that taxable benefit of 1.5 means tax of about 750. And then if it's not assessed properly, this is a ticket bomb. Because this means that if the client gets audited in the future, that 750 that could be plus interest, plus penalties, that could be maybe $1 million down the road. So this is why we need to know these values. This is why it's necessary. It's important to know the fair market value to avoid surprises like this for a client. And then as you go down, if you transfer a fair market value, all the tax consequences are in the corporation. And well, in this case, the individual has to come up with the $1.5 million, but at least the tax liability is not 1.2, like in the first line, 450 plus 750, that's 1.2. At least on the last line, it's half of it, it's 700, half of the 1.4, $700,000. All that to say, you have to be careful here when we transfer, and then we need to know the fair market value all the time. This is another example where it's pretty much the same result. The only thing in this case, the corporation, the shareholder is a corporation, but you'll see, again, we pay in dividend. I take the same features, and it's the same exact tax consequence. With no consideration, there's a policy gain of $900,000, taxable benefit on the holding of 1.5. So all that to say, this is another example also where now we have two sister corporations because you're transferring activities. There's also going to be, in this case, same example. In this case, let's say sister one, corporation one, transfer to corporation two. If there is no consideration paid, corporation one would have a $900,000 of policy gain, half tax, 450 on taxes. And you look at the operating corporation two here. Corporation two here, it says NA, non-applicable, and then there's an asterisk. The reason why there's an asterisk because it's not a taxable benefit per se under 51. There could be a benefit under 246(1). Because in this case, if it wasn't for the shareholder controlling the two corporations, corporation one and corporation two wouldn't transfer without a consideration. So in this case, corporation two could be entitled or could be subject, to a taxable event under 246(1) because they are related through the shareholder. So knowing that, if you transfer a policy from two corporations, from one corporation to another, from a corporation to an individual, from an individual to a corporation, maybe it's not the right way or the right strategy when it comes to transferring policies. Maybe there's other possibility. This is where I just listed a couple strategy here. Instead of transferring the policy, if the gain is too large, maybe there's a possibility of transferring the asset of the corporation. Especially we talk about either it's a holding corporation or an operating corporation. One way, if you transfer the other asset, you could do a rollover, the 85 rollover on the other asset. Now I'm not talking about the policy anymore. I'm just talking about the other assets in the corporation. One way would be to do an 85-1 rollover, transferring the asset, but you have to think about sales tax. If you're transferring inventory, there might be sales tax. There might be business income. And with business income, there might be taxes to pay. I didn't even mention that on my slide. It might be tricky because now you're transferring all your assets into another new corporation. That new corporation needs to get new income tax numbers, new sales tax number, new different tax accounts. That could be an issue. On top of it, it could be also an issue because if you're transferring into a new co, and that new co gets an offer within the 24-month period, that corporation might not be entitled to the capital gain exemption, because the capital gain exemption, to be able to take advantage of the capital gain exemption, the shareholder needs to own the shares being sold for at least 24 months. And then during those 24 months, we need to respect the 50% test. But also, that could be an issue. And on top of it, there's a potential corporate incest here. The corporate incest is when you have two corporations, mother-daughter, and then the mother owns the daughter and the daughter owns the mother. It's a corporate incest. It's not supposed to happen. There's easy ways, but that's something to keep in mind. And also safe income issue. It might be safe income issue because as I said, if we pay in dividends between two corporations to reduce the value of the corporation being sold, that could trigger a safe income issue. So that could be an issue here. And then 55 of the ITA is that's actually the provision that turns the non-taxable tax-free dividend into capital gain. All that to say, when it comes the time to transfer policy, it's worth looking at, can we just transfer the policy? Can we transfer other assets in the corporation beside the policy? These are just a few takeaways here. I just want to focus on where it says no taxable slips. The one on the top right-hand side there in gray, it says no taxable slips or issue for taxable benefit. That means that I showed you several examples. There is a calculation for taxable benefit. There is no tax slip issue for that. It has to be calculated by the accountant. The accountant needs to be aware of what's going on when you're transferring policy. The client needs to tell the client, or you guys need to inform your client, at least tell your client to tell his accountant to calculate that benefit. And I just want to finish quickly here with our team. This is our team based out of Quebec. We're a team of 10. I just want 10% of the team here. We have, we can assist you with your files. And locally, this is our team. Venora, Abigail, Rushi, probably has worked or will work with them. These are some of the pictures, Shelly, Jacqueline. Feel free to contact them. They'll be more than happy to reach us, and I'll be more than happy to help you in your cases. So this is pretty much finished. Thank you for listening at the end of the day. And then if you have any questions, feel free to ask. Yes.
Great. Let's give him a gentle round of applause. Thank you. We're finishing off with a very practical session. I did have a question, I think from online, it's from a Zoom chat, but I can't see it anymore here. I think it's, if I can recall correctly, it's that what happens if a husband has a corporation, the wife has a corporation, so are they considered related because of their marital relationship?
Yes, definitely. Wife and husband are related. The question is the corporation related?
Yes.
Yes, the corporation would be related.
Okay, question.
And on top of it, they would be associated. And then related corporation and associated corporation, they sound similar, they look similar, but they're used for different purposes. Anytime it's actually, I've never seen a situation where two corporations are associated but not related. But is it possible to have? Yes, it's possible to have two corporations related but not associated.
Okay, chat with Min Jung-gu more if you have questions about relationships in general. So thank you, everyone. Unfortunately, our time is short today, and I know we're keeping between you and the bar, so I don't want to do that to you. So
I did my bar. You don't need to go to the bar.
Thank you. And so, thank you very much for today. And so if you have questions, I'm hoping you'll still stick around for a little bit?
Yeah, I'll be.
Okay, sounds
I'll
good.
stick
He'll
around
be
for
at
this cocktail.
cocktail. So it's bound to be a very interesting conversation.
Ask your question before I'm drunk. I'm just
Right.
kidding.
So thank you very much.
Thank you.
Okay, so before I let you go, and actually the winners of the prizes are already announced.
Right.
But before I just
Thank
close
you.
off for the day here, I'm going to invite Angelina to come up here to share a little bit about Abacus and membership and what